before I go into the presentation, I just really want to thank you all for being here and being part of it. You know, I know I've mentioned this about our team. Our team's done a great job. Specifically, Steve and Joe have done phenomenal jobs putting this all together. I want to thank all of our sponsors for, you know, like Tyler, who was just on here from the CMT, for making this possible, helping making this possible. So thank you all for really being involved in this. Okay, so let me let's talk about, and let me see if I can. Where do I moved everything around, so I want to figure out where's my advanced screen. You guys got to give me a second here. Okay, here we go. All right. So the discussion today was really about the dollar, and it's been quite messy. It's been a messy market, and it's been hard to make heads or tails of the dollar. And today, specifically, I mean, we were talking about the flows that were going to move the market, not so much, you know, anything else. And really, that's what's driving the market at the moment, our flows. But if you look around at what's driving the dollar and other currencies, it's just been a mess. And so what I've called it is really the quagmire of the dollar, because it's it's just kind of, like I said, it is a mess. So the dollar at this point in time is in a very tricky situation. And I say it's in a tricky situation because the Federal Reserve has taken so many steps, which we're going to outline them, so many steps into trying to mitigate the strength of the dollar to try to provide liquidity since COVID-19. And, you know, if you take everything that the Fed's done, which we're going to talk about, and then look at where equities are at now, you would have expected that the move higher in the stock market would have produced more of dollar weakness, which, like I said, we're seeing dollar weakness at the moment, but that doesn't necessarily mean that it's going to stay longer term. And so what I was going to do is I'm going to talk about a bunch of different things. First of all, we're going to talk about the bearish argument for the dollar, because there are great points against the dollar. We're going to talk about the bullish arguments for the dollar, which there's a lot of bullish arguments as well. And this is one of the, I think, the issues that FX traders that we have, is we can argue both points of the dollar at this stage in the game, and that's what makes it extremely difficult. Usually, when you're trading currencies or trading anything for that matter, it's much easier when you can pinpoint, these are the reasons why I want to be a dollar bear, or these are the reasons I want to be a dollar bull, and really run with it. But right now, like I said, it's there's pretty valid arguments for both. But I personally have come to more of a conclusion on how I feel about the dollar. And maybe after this, you might feel the same way, you might not. And that's what really makes a market, right? So is it really just a dollar story? And I think we all can agree that it's not just a dollar story. And we're also going to talk about what the corresponding markets are telling us. And we're going to look at what the charts are telling us. And I'm running fairly short on time, but therefore some of my charts I already started doing a little bit of work to get through it, because what I love to do is start off with a clean slate and go through the different markets and show you what I'm looking at. But I already started while Tyler was speaking. I'm like, oh, I'm running low on time. I need to go ahead and make some adjustments as we go. All right, so, and then I'm going to give you my thoughts on the dollar, my final thoughts on the dollar. So let's talk about the dollar bearish arguments. Like I mentioned just a moment ago, unprecedented move from the Federal Reserve, and this move from the Federal Reserve is going to eventually just destroy the dollar. These are the bearish arguments, right? And we really got to start with what actions have the Fed taken thus far? And this is where it gets very tricky, especially for somebody like myself. I consider myself more of a technician than a macro guy. I do trade with a firm with some of the I think are some of the most intelligent guys in the markets in general. I watch these guys fly through news. They look at, let me see if I can show you this. Like this is Bloomberg, right? And this is like you know, like hot stories that are coming through the market as they come flashing through the market. You can read up on everything, and then I have different news streams that come through Bloomberg, and the guys that I work with, they can run through that news and they can read them almost as quick, excuse me, as some of the algorithms, and they could decipher it and make a decision. And that's awesome because myself, I look at some of this news and it takes me a little bit of time to process everything. And I'm sure, some of you probably feel the same way. And so what I was doing is I was going through what the Fed actions have been. And what I realized is I actually had to go through the Brookings Institute and start looking at some of these acronyms, because as Steve mentioned earlier this morning, and this was kind of funny that Steve said this, is that he thinks that some of these central banks have created all these CVPs, these or SVPs, special SPVs. Sorry, yeah, special purpose vehicles with all these different acronyms to confuse the heck out of us. Which I'll tell you, Steve, I was going to list all of them and just say, okay, here's some of the actions that the Fed has taken. And then what happened is I started looking at all the acronyms, and I see them all, and I see all of these different special purpose vehicles being built, reestablished, and I'm like, wow. So I had to just basically take all that information, put it on the presentation here, walk you guys through it, because I think it's going to be quite, I don't want to say alarming, but it's going to be quite amazing when you go through all these things and you go, wow, the Fed's really done quite a bit. And that's important. So we're going to go through them. This part's going to be a little bit boring if you know some of them, but I think some of them might be a little shocking to you as well. So first and foremost, we talk about rate cuts. Obviously, the Fed has brought rates. You think about what the Fed's done in the last several years by raising rates. They did it specifically for this environment. We're in a situation where the Fed had to bring rates back down to basically zero, and they did 2 emergency rate cuts, and that's the first time they've done that since the financial crisis, the GFC that we love to call it, and that's pretty amazing. But you realize now in hindsight why the Fed was raising rates, and you look at other central banks, they don't have that tool available to them, if you will. All right. Now also, the Fed has employed what we call forward guidance. Forward guidance, in my opinion, is probably one of the most valuable tools that the Fed has, because what they've been really good about doing, and I know there's debate on this. You don't have to agree, or you can agree or disagree with what I have to say, but the Fed is much different today than it was like the Greenspan Fed. The Greenspan Fed, we'd get surprised with rate hikes and rate cuts. Like you never knew what you were going to walk into, and it surprised the markets quite a bit. Right now, I mean, obviously the COVID-19 situation is an outlier, but generally speaking, we have a pretty good idea of what the Fed's going to do. So it doesn't surprise the markets as we move along. And I think that's important, because the Fed can really shape the way that we think. If you look at the Fed today, and the Fed, I mean, Powell basically said, we're going to keep rates low for, it seems like, what would be forever. But you have banks like Goldman Sachs a couple of weeks ago that said, hey, the Fed's going to stay on hold probably till 2023. Until inflation rises and we're back to full employment, which could be, now they might have, moved out those forecasts based on the forward guidance that the Fed has given at today's meeting. But that's important to understand, that the forward guidance it's really like storytelling for them, and giving you Easter eggs along the way so you can kind of understand where they're going and how the story is going to eventually end. And that's what forward guidance is. And I think it's one of the most important things that the Fed, important tools that the Fed has. Now, what the Fed has done, though, is they have done many things to really support the functioning of financial markets. So, obviously we have, quantitative easing. And even though the Fed says what they're doing right now is not quantitative easing, uh, everyone else is calling it quantitative easing. We're kind of calling it what it is. But the Fed has brought, bought trillions of long-term securities. And when they cut rates to zero, they started these large-scale purchases again because of the pandemic, right? So QE is what we're all accustomed to hearing. We're like, oh yeah, the Fed's doing QE again. But what they've also done is they've done other things like, lending to security firms through the discount window. Now, in the past, these discount windows that, the dealers or the banks, them accessing funds from the discount window or the primary dealer credit facility, the PDCF, as they call it. And again, these are these acronyms that we're going to start going through that you're going to go, wow, there's a lot of them. They used to, the street would see that as a sign of weakness if banks or dealers or primary dealers were accessing the discount windows. They'd be like, oh, that's a show of weakness. But obviously, because of the pandemic, everybody is running over to the discount window, and the Fed actually, instead of making those loans overnight, they now allow them up to 90 days, which is a substantial amount of time. All right, and also, I guess one thing I should mention is the securities that they have to put up in order to access the discount window. Those regulations have been loosened as well. Now, this is where it starts to get a little bit more confusing with all of the acronyms, and that's why I referenced the Brookings Institute. They've done a great job in outlining all this, and so I was going to try to put it in my own words, but a lot of this you can just access right from their website, but I thought I'd share a lot of it with you. So they're backstopping the money market mutual funds. When we had, when the pandemic originally hit, I mean, think about all the people that started liquidating their mutual funds, trying to access capital. Well, that put a strain on the system. So the Fed launched the MMLF, which lends to banks against collateral they purchase from prime money market funds, the ones that invest in short-term IOUs known as commercial paper, as well as treasury securities. So again, this is another action that the Fed's taken. They have their repo operations. We've heard a lot about the repo operations, but this is where, the Fed has vastly expanded the scope of its repurchase agreements. And this is to funnel cash to money markets. And now this is key, essentially offering an unlimited amount of money. And you heard the Fed Chairman Powell say today, even today, he's like, we're not going to run out of money. Running out of money is not the issue. This is where the Fed is basically supporting the financial markets, making sure that it's operating fluidly, all right? All of these different actions that you see here. And like I said, it's quite amazing. Now, they're also encouraging banks to lend. They're encouraging sorry, my alarms are going off here, through the discount windows. And that's direct lending directly to banks, making sure that they have funds available to them. Also, they are temporarily relaxing the regulatory environment. So they're encouraging these banks to lend, and all the bigger banks, the community banks, and they really have relaxed the collateral that banks had to use to access the monies from the Fed. And again, this is just to say, to make sure that banks are out there getting money out in the system. Now, they've also supported corporations and businesses. Now this is where you start to see some of those acronyms like the PMCCF, the Primary Market Corporate Credit Facility. And, when I see these headlines come through on Bloomberg, and I see, oh, well, the Fed has reestablished this, And then I move along. I'm like a lot of you traders. I have a bit of ADD when it comes to trading. You hear something, you process it, and then you're moving on to the next thing. But when you go through it, you realize all of these, again, all of these programs that the Fed's incorporating. Here's the Commercial Paper Funding Facility, the CPFF. Right, so this is a $1.2 trillion market, which firms issue securities, unsecured short-term debt to certain money market funds and others to finance day-to-day operations. Again, this is how they're supporting small businesses. And then we also got this as supporting loans to small and mid-sized businesses as well. And by the way, going back to the last slide, I actually had a friend of mine, a good friend of mine, that accessed those funds as well. You know, I said, "Oh, did you access the PPP?" And he's like, "No, I accessed this other liquidity measure from the Fed." And this is the Fed just helping support businesses and corporations. And what I'm trying to illustrate to you here is the Fed has taken on a massive amount of, you could say, liabilities, but massive amount of action to really support the markets. Then they're even supporting state and municipal borrowing as well. And I'm running short on time, so I don't want to go through all of these. I want to move through them rather quickly, but I want you to, stop, read up on them, and then, move along. So supporting bond market liquidity, and also cushioning money markets from international pressures. And this is big because so many central banks are accessing money from the Fed, and so the Fed had to provide that liquidity. So what is this all, where is this all going? Is part of the argument is the balance sheet of the Fed is getting too large. Confidence is going to be lost in the dollar because the Fed is making all these unprecedented moves. And more arguments towards the bearish argument of the dollar. The bounce back in the U.S. global economy means less need for U.S. dollars. As you guys know, as the market bounce back, people will sell their dollars. They're gonna reallocate them into different currencies, into different places. And so this is, again, part of the bearish argument. A bounce back in stocks, we just mentioned, will ultimately lead to the U.S. dollar lower. And as the economy has that reflation environment, the reflation trade, the U.S. dollar is going to head lower as well. And yields will continue lower, thinking like, the 10-year dropping to zero or even negative, some people have argued, will take the dollar with it. So these are the predominant dollar bearish arguments. And I really want to talk about the dollar bull arguments. Okay, so the bull arguments are, the dollar is still the least dirty shirt in the hamper. You always hear that term. The positioning in the market is that everybody is short the U.S. dollar. Everybody positioning. So being short the U.S. dollar, it's going to lead to people covering. And it's going to be, make it a very bullish dollar environment. The deployed dollars elsewhere is going to have to come home. As Adam Button mentioned a little bit earlier, dollars are everywhere, and he even mentioned that half those dollars are not on our shores; they're elsewhere. They're deployed elsewhere. They're going to eventually have to come home. So that's going to strengthen the U.S. dollar, and because the U.S. dollar is a reserve currency, there's going to be a shortage. So that's going to be that rush to dollars. We kind of saw the beginnings of it at the beginning of the pandemic. We saw that rush to dollars, and everybody sold the euro, sold the Aussie. The Aussie dropped to 55 cents. The cable dropped to 115. Okay, so that's, again, this is part of the dollar bullish argument. And safe haven assets will come back into demand, which the dollar being the ultimate safe haven currency, and a deflationary environment will be dollar supportive. So, and there's more arguments out there. You could throw a couple other hot topics in the dollar bull, dollar bear argument, but I just wanted to bring up the major ones that I've heard. Okay. Oh, and then also a wave 2 will usher in a stronger dollar eventually. Now, when I say a second wave, that is not referencing the virus. I'm not a medical expert. I have no idea what's going to happen with the virus. All I can hope is that we don't have a second wave in the virus. But when I talk about a second wave, I'm really talking about a second wave in the economy. I think the economy is excited to get back to work, but the argument is, and this is where you start talking about behavioral, um, our job's going to come screaming back. I doubt it. Are people, like, you think about people like me? I've got a family. I'm married with kids and dogs. Am I going to be traveling anytime soon on a plane? People like me, maybe, maybe not. Maybe I'll drive somewhere. I don't. Is life going to go back to normal? And I think there's a lot of arguments that would suggest that we're in a new normal, and the economy is going to take a long time from an L-shaped environment to recover. So therefore, a second wave of dollar buying, if you will, is probably going to come back, and we're going to see, the stocks come down and the dollar come back into demand. So that's what I'm talking about as far as a second wave. But then you have to ask, is it all about the US dollar? And the answer to that question is no, it's not all about the US dollar. The dollar, when you take the dollar index itself, is weighted heavily to the euro and less to everything else. And so that's why when you look at the dollar index, it's a little skewed. When you look at it, I don't look at the dollar index and I haven't for years, as much as some people do, but I know it's still very commonly followed. So therefore I have to follow. And that's why on ForexAnalytix, we use the dollar index, because it's followed quite a bit. All right. So one of the tools that I use, having Bloomberg, is I use the Bloomberg dollar index. It's a more evenly weighted dollar index. And if you use like Gain Capital? No, FXCM. I think they have a similar type of index called the US dollar. But using something more equally indexed is more powerful for me on an intraday basis. And I consider myself a swing to very active trader. So, when I try to look at longer term views, like you can see this weekly chart on the Bloomberg dollar index, I look at it, I glance at it probably once a day, and I note where those levels are. And what I'm, showing you here is, yes, we are actually threatening on a more equally weighted basis. We are threatening a dollar breakout. Now, one of the instruments that Mark Chandler talked about yesterday, which kind of, this is the problem with when you're one of the last in line to talk and to present, you don't always get to, don't always get the thunder here. Somebody else is, will use it, or they get to it before you. This is a trade weighted real dollar index that I look at from time to time, and you can't even get candlesticks on it because it's updated rarely or less frequently, but it really can give you an overall feeling of the dollar. But you notice that the dollar is not too far from breakout territory, and on a broad trade weighted index as well. So since the dollar index is made up predominantly of the euro, all right, we do have to discuss the eurozone and the euro currency itself. And the question that I always ask, and I think a lot of you probably ask as well, is the euro a valid currency, or is it just a project, and will the euro go away? And there's a lot of debate there. I'm not here to say, what's right and what's wrong, and I don't have time to debate with you back and forth whether you believe in it or whether you don't. But one thing that I'll have to say about, is the euro is it a project? One of the things that I've believed for many years, and if you follow me daily on the FACE webinar, I talk about having a fiscal union. And one of the things that was not displayed recently is, and the ECB is engulfs the eurozone, but having a fiscal union of some type is what would put the stamp of approval for me that the euro should be bought in mass. It'll be more of it's here to stay. And the problem has been that you can't get every eurozone country to commit to that. And I understand the reason why. It's kind of like the United States. You've got Texas, New York, California, and then you have the rest of the United States, and those are the states that probably produce the most, income. But in different regions, it's like taking Germany and France and Italy and then everybody else, or something like that. And we as Americans, America was formed, obviously a long time ago, but the Eurozone's trying to form in today's world, and that's where the disconnect is. It's like, okay, I'm Germany, and do I really want to be responsible for what happens in other Eurozone countries that aren't doing as well, or vice versa? And so because of that if there was some sort of fiscal union, I would feel a little bit different about the euro as a whole. But if you look at what the ECB and the European Union's actions have been over their COVID-19 response, you can see it on the screen. You can see what the ECB's done. Now, obviously, the ECB today, I think they added another 20 billion to their a month, and that they adjusted their LTRO program a little bit. So I just added that this morning because of some of the actions that the ECB has taken. But what you'll see here is it's substantially less than what the Fed has done. And same with the Euro group, and they put out a couple of weeks ago that they're going to have a package of 540 billion, and I'm sure that's going to expand a little bit. But you can see it's dwarfs in comparison to what the Fed has done, has done as of yet, or as of now, excuse me. And so that's where you have to start thinking, well, am I looking at just the dollar, or do I have to really focus on other countries and what they've done? And that's why, I have to say that the US dollar, you can't put it in, I'm buying the dollar, or I'm dollar bullish, or I'm dollar bearish. I tend to be dollar bullish against certain pairs and bearish against certain pairs. It depends on the country that I'm dealing with. That's why we have to look at different currencies and understand what the specific relationship between the dollar and that specific currency is, versus just kind of blanketly saying I'm a dollar bear or I'm a dollar bull, because I think that's a cop-out, right? Overall, it's a cop-out. You have to really say I'm a dollar bull, but against the euro, or I'm a dollar bear against the against the Aussie, or something like that. We also have to take a look at the global equity markets, specifically the S&P, but I think that the correlations will not lie that that we have to pay attention to that correlation. We have to obviously look at gold, and we have to look at the bond market. That's really important. So that's where I'm going to first and foremost, I'm going to take, I think I can do it this way. Can you guys see my charts? Dale, can you see my charts?
We can.
Yes, sir.
Okay, all right. So I just want to make sure if I overlapped them like that, you could see everything. Now, let me give ForexAnalytix a little bit of a plug here, just because ForexAnalytix, we cover like so many different instruments and so many different markets. It's important that you understand that it's not just currencies. We cover the DAX and the S&P. We cover Bitcoin, and we cover the bond market. So it's important to understand that. And also, like when you're looking at the dollar index, it's not just basic technical analysis, which tends to be my forte, but we have harmonic analysis, which you've heard from Andre today, and his looks. And then you have like the Elliott wave analysis, which is from Gregor Horvat, which you heard from yesterday, which talks about different Elliott wave counts and how he feels about the dollar in general. So I just want to mention that about ForexAnalytix. It's not just about currencies, and it's not just about basic technical analysis, although that's what I'll be covering here, all right, at this moment. So what I did is I wanted to show you all of these major currencies, and I want to talk a little bit about where things have changed and kind of what's happened in the market. And if you're looking at the euro, like just as the euro in general, you can really argue that the euro is in a, in a consolidation of some sort. Okay, it's very messy. And I've outlined the reasons why I think it's pretty messy is that, there's a big bull and a big bear argument that's going back and forth. So you can see why we're flip-flopping a lot. And then you throw in lack of liquidity, you throw in month-end flows like we saw today, it's going to muddy the picture a little bit. All right, so overall, if you look at the euro like on a weekly basis, it is moving lower. And you have to take that into account. You have to say, well, as long as the euro is below 115, I've got to continue to be a euro bear or a dollar bull, at least against this particular pair. That doesn't mean that the euro can't strengthen. And, one of the things there's a lot of things that I wanted to mention today and a lot of things that I don't think I'm going to get to because of time. But one of the things that I like to explain to people is I may have an overall bias of like the euro. Like, for example, I'm a euro dollar bear. Does that mean that I'm bearish the euro all the time? No, but if I'm a euro dollar bear, whenever I have a bearish setup, I'll be more aggressive to the downside. But if I've got a bullish setup, I'll be obviously less aggressive. And this is where I think Adam mentioned it this morning, where size matters. Size does matter when you trade, and it's not only the motion of the ocean either. That was a joke. I got some of you guys to laugh, right? No one's laughing, maybe?
I am.
Okay, you laughed. Okay, that's good. I figured somebody was going to laugh at that one. Not just the motion of the ocean, it's the size. All right. Anyway, like today was a perfect example of, I was telling everybody in the chat room, look, we have an inverted head and shoulder pattern with the euro. It should target 110 if we break out. I think you might have heard it this morning. We came, pretty close to 110. Now, is it over and should you fade it here? I mean, that's up to you. But I'm just saying that, like today,
was a great call play.
I was obviously focused on the presentation and on our event, so I wasn't really if I wasn't spending a lot of time in front of the markets today.
That's okay. Everyone else caught it.
Yeah, I'm sure everybody did. I mean, before I was coming on, before the fix, I was like, hey guys, the euro's pretty big. I'm like, wow, and we had gone from 40 to we were trading at 80, and obviously the breakout, ushered in a lot of buying there too, along with the fix. But the point I'm trying to make is, even if I traded the euro on the long side today, it would have been in a smaller position size because I'm more of a euro bear than a euro bull at this point, right? And it's really comes down to like the longer term chart showing you that, hey, I think the euro is at risk of continuing lower, towards parity and beyond. And
wow,
the one thing that would have really changed my mind about the euro dollar in general would have been at the Euro group meeting, if there was some sort of euro bond issuance, I would have said, wow, fiscal union, Eurozone fiscal union, my attitude may have changed quite a bit, but it hasn't. All right, cable, I think Mark Chandler said yesterday, the cable shouldn't have been at 115. That was, clearly a, place to be long. Arguably so, because it was a false breakdown. But overall, the trend is still lower. Until I see some of these longer term trends change, I have to continue to believe that the cable, even as long as it's below 130, it's probably a short. Now, that doesn't mean it's, a short right at the moment. Today I was saying, hey, we break above 125, we're probably going to go to 126. I think we're trading above 126 right now. We are. And if you read the ForexAnalytix analysis last night, that's what it said too, is, looking for possible move to 126. Now, this is the dollar yen. And this one has been This is the chart that kind of changed my opinion on the yen, and rightfully so, because we've seen the way it's reacted as of late, especially through this whole pandemic. And I have to kind of go backwards and take us back to the point where we broke above 110. And when the dollar yen broke above 110, I was like, wow, the correlation actually broke where, or is playing catch up rather. And it was a breakout. It was massive. There was a lot of institutional buying, mostly from Japan, and a lot of pensions buying, post office, the government agencies were buying. So I knew a lot of long-term buyers were in the, selling yen, basically buying dollars. But also at that point is when we, started to think, okay, the correlation, and we talked about this on the FACE webinar at that time, that the correlation between risk on, risk off, and how you treat the yen we might start to see a longer term change. And we have seen that a little bit, although during the pandemic, you saw the yen really strengthen, but it came back quite aggressively. And if you look even now, the dollar yen is holding up pretty well considering where stocks are. Now, that's not to say that when stocks come down, the dollar yen won't come down with it. I just think that the way the yen has been used as a safe haven type of currency, I think won't be quite like that moving forward. It's still, it's not like and I tell our listeners all the time, it's not like a switch gets flipped and it's like an on and off switch with a light that all of a sudden the yen's not a safe haven currency anymore. It takes time in order to make that change. And I think that's what's happening right now in the currency market. And I think you're going to see that continue as we move forward. Even if the S&P does drop back to 2,500, how's that going to impact, the dollar or the dollar yen? Now, if you take a look at the dollar Swiss, by the way, this is another currency that is extremely messy, and you're not seeing the Swiss franc act as well from a currency risk on standpoint. But and I could go through all of these pairs, but I know I'm running over time right now. But I really wanted to take you over to like the S&P, and I want to take you over to specifically like the dollar. And let me compare the dollar. And this is much easier than me doing it via Bloomberg, because what I can do is go through Bloomberg and run through these charts. But these charts, I'm not as fluent in using these charts. I don't think it's as user friendly. So therefore, I love using TradingView. So you can see I use them both. But you'll notice that the dollar, under extreme stress of the stock market, the dollar does act as a safe haven currency. And that's one argument that I've brought to the table for our ForexAnalytix subscribers, or not just that, for our FACE listeners on a daily basis, is that the dollar may act as a safe haven only when the market feels extreme risk off. When I use the term, when the poo hits the fan, people drop everything and say, I'm going to buy dollars. That's it. I just want to own dollars. It's a reserve currency. Get me back into dollars. And that's exactly what we saw as the pandemic hit. The dollar started to strengthen. Prior to that, even when we had little blips lower, you can see this one right here. We had a little blip lower in the equity markets way back in the end of 2018. The dollar didn't do anything. It didn't strengthen. People weren't panic stricken. What has happened today or in recent months is a crisis. This pandemic is for real and people are concerned. So if stocks start to move lower from here, I would expect that the dollar reigns supreme. All right, and that I do not doubt. The question is, which currency do you sell? And that's when you start to break them all down into, I'm more excited to sell Aussies versus the Kiwis because of the exposure that Australia has to China, and the New Zealand dollar, or New Zealand has less COVID cases, whatever your argument is. Or I'm going to sell euros because I think that the European Union is toast, so therefore I'm going to buy dollars against the euro. So it's not a one size fits all, and that's the point I'm trying to make here regarding the dollar. Now, obviously, we look at gold and we look at yields as well. Again, I'm running very low on time, so I need to go through this really quickly. The one point I always try to make with people is if you do see the dollar and you do see gold moving up at the same time, that's usually a sign of, the market's pretty stressed. When the market's buying both gold and dollars at the same time, that's usually a pretty good inclination of risk on or risk off. So what I wanted to do is really quick is go through, my thoughts on the dollar. And, when you talk about like the balance sheet of the Fed, look at the Bank of Japan and look at the difference between the Bank of Japan, the ECB, the Bank of England, the Fed, and where the Federal Reserve is at. I think that the balance sheet exploding, I do think it's a little overblown, and I think we have more to go. So when you hear the Fed Chairman Powell say we're not going to run out of money, and I've got plenty of ammunition here, he's not lying.
What a great chart, Blake.
Yeah, and this comes from the Financial Times, but it really, the Fed can do more in relationship as percent of GDP. We can. So I think that those fears are a little overblown. Europe is a mess. And I think Europe is gonna continue to stay a mess until we see some sort of fiscal union, and therefore the U.S. dollar is the place to be near term. I meant to put animation in here, so you didn't see them all at once, but yeah. All right, so I missed it. The world is near ZERP. Years ago, you could go back 3-4 years ago when we were on Face, and I said, mark my words, guys, everybody's going to be at ZERP soon. We're getting there. We're almost there. There are obviously some emerging markets where their central banks are making their way lower still, but for the most part, all the G7, G10, everybody's going to ZERP. The reason why that's important is because I don't think currency volatility is here to stay. That was my next point. Volatility is here to stay, and you can see it in the here's euro. By the way, this is euro 1 month implied volatility. You can see that big spike up, obviously, because COVID. I think volatility is going to be here to stay. We want to see volatility above 5 in the euro. You can look at the dollar yen too. It looks very similar. I think volatility is here to stay, but I don't think currencies are going very far because everybody's at ZERP. So if you're in the camp of, oh, so the euro is going to 120 or the euro is going to 88 cents, I'm not in that camp, because I think while everybody's at zero, the longer term trends are going to be fairly muted. But that doesn't mean that we're not going to get action in the markets. That just means that you should be very weary of overblown moves in the market. Okay, as far as the dollar goes, now that doesn't mean that you won't see outsized moves in crosses like what we saw in the euro Australian dollar or the euro New Zealand a couple of weeks back. Those outsized moves may happen. Euro Mexican peso, same type of thing. But in terms of the dollar, when everybody's at ZERP, until you start to see moves off of the floor, it's probably going to wait. Hold on. Okay, sorry. I was Germany's Merkel was talking about something, and I thought she might have been. Whenever she talks, I'm like, fiscal union. That's the first thing I look at, and it wasn't. It was just a headline. She was talking about travel restrictions, so it's nothing, nothing big. And the last point I want to bring up, and I know I'm way over time, but the last point I wanted to bring up is election risks. Now, I don't want to. I don't like bringing politics into the market. I have my views, you have your views. They're irrelevant as far as the market goes. Our views are. but what happens is relevant. And, you know, I think, and I know Steve has a lot to say about this, and I'm going to echo kind of what you would say, Steve, is that, you know, if Donald Trump comes in, you know, I think the dollar could still, you know, kind of act what it the same way it is. But if a Democrat gets elected, you're probably going to see the dollar weaken some. And just because I think Democrats tend to be a little bit more loosey-goosey with from a monetary standpoint and fiscal standpoint, so you might see the dollar come under a little bit of pressure. But that's something that you have to keep in the back of your mind as we head into the fall, not necessarily things we're thinking about right at this moment. But like I said, I was running a little late on time, and I wanted to say thank you guys for bearing with me. I know it's not the most exciting presentation, and there's a lot of currencies that I didn't even get to that I really wanted to get to, but.
Would you like to tell the people where they could find you, Blake?
Right here.
If they want to follow you.
Hey, just so you guys know, I'm Pipzar on Twitter, but that name was given to me by a client or a customer of Wise Trader MB Trading back when I was chief currency strategist there in like 2005 or 2006. Just as I joined Twitter, just before I joined Twitter, so we were giving each other. It's when they did the Karzar, and we were giving each other pip handles, all of the clients, and people were like, I'm the Pip Indian, I'm the, you know, Pip Slayer, Pip, you know, everybody's like, and somebody said, you're the Pip Czar instead of a car czar, you're the Pip Czar. And it kind of stuck, and everybody just started calling me that. And that's how the name came. So don't think it's like, oh, I crowned myself the Pip Czar. No, it was actually given to me by a client, and I just kind of ran with it because everybody just said, hey, Pip Czar, you know. So it's kind of, you know, they called Steve Dingleberry. Just kidding, Steve. I love you, man. I'm just kidding. But Pips are on Twitter. But you guys know I'm one of the co-founders of ForexAnalytix, and you can find us on the Face webinar every day, every morning for free. And then obviously we have paid webinars, or I say paid webinars. They're webinars that are included with your subscription. If you're a member, you get like the daily roundup, the European crossover with Polly, and I do the daily roundup, and you'll find me every morning here. And
Blake, I just added on chat the Traders Summit offer link also for people to take advantage of.
Thank you very much. And you know, I want to say, you know, thanks everybody for being part of this event. And if you had any questions that came through, because I'm not going to be able to address those questions right now, catch me in the mornings. I'll be there tomorrow morning. Tomorrow, Friday?
Yeah.
TGIF, bro.
Woo-woo,
yeah.
It's Friday tomorrow. All right. So I'll be on tomorrow morning. I also put
the link. I told people that they can find us every single day on the Face webinar. It's free. They can sign up and they can ask as many questions as they want there.
Great. Okay. Well, hey guys, thank you. Thank you so much for being here. Thank you so much for your support. And all of our sponsors, our wonderful sponsors, thank you to them, because without them, this wouldn't happen. And without you as well. So stay healthy, stay safe. I'm out.
See you, Blake.
Bye-bye,
Stay
Blake.
hunting the rest of the day.
Thanks, guys.